So something like that, if there's even a whiff of that kind of a panic today, the Federal Reserve would step in, and they wouldn't even have to put in money. They would just say that they're willing to put in money, and that generally stops a panic. So that happened in the '87 stock market crash, for example, where the Federal Reserve just announced their willingness to intervene, and that kind of stopped the panic. But back then, they didn't do so. So you had a huge collapse in the money supply that depressed incomes, it depressed asset values, and it spiraled. And you didn't really see a bottom to this until the spring of 1933, when you started to see some monetary reforms. The U.S. got off the gold standard, and there were a lot of other monetary reforms. But I just wanted to highlight, because I thought it was interesting. Sorkin was being asked a lot of these questions about, what are the parallels then and now, and of course, in a lot of these videos, Sorkin doesn't really have a chance to get into it in any big way. But it's interesting having, with Sorkin having studied both the financial crisis, the more recent financial crisis, and then the '29 crash, what those parallels are. But it's important to talk about the differences just as much. Now, I'm not suggesting that a broad financial crisis is ever off the table. Having lived through the 2008, 2009 financial crisis, and then the pandemic, certainly the idea of a financial crisis is not off the table. But I think it's important to know that these things are likely to happen in credit markets, and particularly short-term credit markets,